Hey, so it's your friendly neighborhood Alibaba counselor reporting for work again. I'm not too sure how I've stranded myself into this position, but clearly, many of you have been reaching out, asking about my thoughts, my opinions on Alibaba, looking at how the US market is rallying, and you're stuck essentially back holding. I'm doing a free service here, so the best you can do is to help me smash that cute little like button. So I think it's been some time since I kind of sit down, maybe gather my thoughts and to prepare like some sort of a PowerPoint deck. So I think just sit back and enjoy this free Baba counseling session. But anyhow, I think to really focus on why I even sat down and spent some time to do something like that, I really wanted to get to the bottom of what essentially many of us meaning all the Baba bag holders, got wrong when investing into Alibaba stock. Because I think when you have this sort of uneasiness or unhappiness, this sort of feeling that actually surfaced to the top, I believe that there is essentially some sort of probably expectations and reality mismatch. And which is why many of you are feeling disgruntled, many of you are feeling uneasy, uncomfortable, thinking about why are other people performing like that, getting 20, 30, 40% year to date, while I, on the other hand, being overweight Chinese stocks. Many of these positions are actually down pretty big time, or at least have been trading flat on a year-to-date basis. Even though everybody seems to be rejoicing, the recession is cancelled, inflation is tamed, but the Chinese economy can't seem to get a hold of itself. Now, I think before that, just to really go through some of the trigger points or some of the discussions that actually transpired amongst myself and all of you out there. There are many modes that you can reach me. You can probably DM me on Instagram. You can email me. Some of you even send me Telegram messages for those of you who actually know my handle. I think just some of the conversations that transpired just this past few days, by the way. I think all these are sent in a matter of 1 week. So this was from last week until yesterday of some sort. And one of the fellow viewer actually reached out to me and like, yo bro, how are you feeling with Baba now? I'm still holding it as well, lol. Nothing much though, I'm holding to painful AF. For those of you who don't know, it's painful as so, haha, wouldn't it be numb by now? Kinda, but just feels like so much time has been wasted. And another viewer actually sent in an email with the title, Should I Sell Alibaba? So he said, Chikeng, I'm feeling stressed out with my Baba position after so long. Should I sell Alibaba now? There seems to be no end in sight. And the email is actually a lot longer, but essentially the first sentence encapsulates the entire idea and message. And another closer friend, he actually do have my contact on Telegram, and he just sent me a quick message asking me, wondering what are my thoughts on China and what I think about the position of the BAT, which is bad, or Baidu, Alibaba and Tencent in the medium term, say 3 to 5 years. The main focus here is really to kind of gain more confidence or to maybe have a counseling session with me and understand why do I still remain so bullish. So I've texted actually a very long reply here. You guys who want to read it, you can just pause the video. I'm not going to reiterate, or I'm not going to just repeat myself. But I think I just wanted to focus more on what exactly we have gotten wrong and focus on why the market continues to punish many of these Chinese stocks. And I think one very intuitive, logical thought process is definitely the Taiwan issue. There's a lot of threats being floated around, whether it's the Biden administration or the Xi administration, claiming that the reunification process is inevitable, and then there are threats being sent here and there. But the funny thing is, actually, if you have to really think about it, the biggest issue or the scariest part of this entire China-Taiwan tension, is it really rested on Chinese companies? Or would there be a bigger problem or bigger challenge for many of these Taiwan companies? And one of the biggest Taiwanese company out there is actually Taiwan Semiconductor. And just a disclaimer, I do have a position in them. And just look at them, how they have performed thus far in the last 5 years, 165%. I think that's not too bad. And on a 2023 year-to-date basis, I think they've been up quite a fair bit as well. Of course, they are riding on this entire AI hype. They are basically the only monopoly that can produce NVIDIA's chips, for example. TSMC has been riding on this whole wave of enthusiasm. But logically speaking, if this China-Taiwan issue is really at the top of minds of many of these global investors, why would anybody still be piling money into TSMC? And TSMC now, I think it's the most valuable chip making company. Chip making, not chip designing. So chip making meaning, I think if you compare Intel, Micron, etc., they're still the most expensive. And I think by no means they are cheap, or by no means there is no air quotes Taiwan discount. So then, is really the China-Taiwan issue a problem? To me, I don't think so. Because clearly, the biggest Taiwanese company here is immune to many of this China-Taiwan tension and threats. Now, moving on, of course, this idea of being scared of our fellow friend over here, which is Chairman Xi. So I think that is a very plausible argument, and there is also one of the main factor that is probably pulling many of this Chinese valuation. And as Samit has tweeted here, it is true that active managers currently have a 5-year low exposure to both China and Hong Kong equities. And on top of that, a lot of the emerging funds, emerging market funds, are also well underweight in many of these Chinese equities. And they are particularly underexposed to, for example, KWEB and many of these other Chinese funds out there. And Submit did include a fourth pointer saying that any China outperformance will probably lead active funds to underperform benchmark. But that's a little bit speculative on his part. So let's just focus on the idea of Chairman Xi and why people are afraid of him. So I think the most intuitive explanation is really how he has conducted his business and his political agenda over the last 2 years. I think it has scared or scarred quite a lot of many investors, specifically due to those very haphazard implementations of policies and how many companies were ripped off the face of the earth just because of a new overnight implementation. But that said, I think there's been certain enthusiasm coming out from China themselves, saying that they want to protect foreign investors, where they want to charm many of this foreign capital back into the country. But of course, we know that once the trust is broken, there is this gap that needs to be filled, and only time will tell whether foreign investors are willing to go back again. But I think that's it. Largely speaking, China is still a massive economy, and there is still a lot of opportunities out there. But it really depends on you as a capital allocator, whether you have inside information, you have greater insights into how things are going to play out. If not, I think many investors have been scarred and many investors have been shying away from Chinese stocks. Do I think this will be a long-term case? Of course not, because I still have a vested interest in them. I do believe in the idea of mean reversion, and it's probably a characteristic of the market, but I'm just not sure, or at least nobody can guarantee you in what time frame Chinese equities will come back to light again. I do believe that if you want to be an investor in whatever markets there are, you need to be fundamentally optimistic. Optimistic about the future, optimistic about how things will play out in the long run, and how companies will figure their way out, countries will figure their way out. And I think China is indeed in a particularly tricky situation, especially when now the dominant narrative is, aging population, the people are not spending money, there's a lot of capital flight, there's a lot of people leaving China, brain drain, etc., etc., etc. The list goes on. But I do believe that many of these issues will probably be solved. And it's basically just a transition phase for many third world going into first world country, where they have to move up the value chain. They need to basically revitalize and to reimagine the entire economy, and all these take time. And of course, for investors out there, if you really want an opportunity, you probably want to buy when there's blood on the streets and not when there's a lot of enthusiasm. And oh yes, just a side note, for those of you who want to get more content or want to reach out to me, you can always do it via email or Instagram. And I do have a Substack platform as well. I do intend to revive my Substack and to continue writing there. So if you haven't subscribed already, the link is in the description. You can just key in your email, and I might do company analysis, my own thoughts about the markets, etc. So yeah, just a shout out. For those of you who want to get more content insights, and I haven't really been posting very actively here. I'm trying to keep to a schedule, but filming a video takes a lot more time and effort compared to writing on Substack. So for those of you who want to get more timely updates of my thoughts and basically different perspectives on different companies, you can just sign up to the Substack link below. Yeah, link in the description. So I think the last part of this trifecta, which is the China-Taiwan tension, Chairman Xi himself, and basically the entire environment in China today. And the last part, which is, I would believe that it's Alibaba as a business. So Alibaba themselves, I think, haven't been portraying a very good picture, or at least a very good report card to investors, which probably also explains why the stock is performing thus far. And also recently, I think in the last few weeks, there is also a lot of discussions around whether Alibaba is a value trap. I believe that there are a few analysts that started jumping out saying that Alibaba is a value trap. So Alibaba's decline isn't just because of regulation, but fierce competition. Its core segment, China's e-commerce, reported a 1.5% decline in sales, and they're the only one to report a dip for 2022. So I think the most intuitive thing when you look at this graph is it does portray a very, very bad light or very, very bad picture for Alibaba's main core business. I think he's essentially just plotting China's commerce revenue, which is the core commerce segment. And you can see that the growth curve essentially just got decimated from a 30 to 40% growth rate over the last, let's say, 5 to 6 years. And then it suddenly went down to negative 1.5%. And it's definitely a call for concern. And intuitively, when you look at an e-commerce business, you would think that, having a decline in sales probably means that they're moving lesser products on their platform. But just do a quick Google search on Statistica. At least in 2022, or at least in the last decade or so, Alibaba's GMV has actually been growing exponentially. I do mean exponentially, from 1.6 trillion renminbi in 2014 to 8.3 trillion in 2022. Just to square away a nuance here, so March 2023, because Alibaba is a very weird reporting year, so if you were to look at just the March 2023 alone, it's the March of 2022 to March of 2023, that 1 year period. And just from this GMV alone, the 3 quarters, meaning Q2, Q3 or Q4, actually do take into account in this core commerce revenue segment. So then you'll be asking me, hey, why is the GMV increasing so healthily, but why is Alibaba's core commerce segment revenue actually declining? I think there is a nuance here. Evidently, because it's just how they recognize their revenue. At the end of the day, Alibaba prides itself as the platform economy. So many of its revenue in this case, they only record the additional incremental value that they produce, which in this case, whether is it take rate from advertisers, from merchants, from the consumers, whatever it is, that's the revenue that they take. However, on the flip side, if you have to compare it to some other companies, they actually do recognize the entire revenue that is being sold on their platform, which is why you can see that even though the GMV is increasing, but their margins are usually razor thin. Alibaba, on the other hand, usually have a lot higher margins compared to many of these e-commerce platforms out here. So if you have to really compare, you should look at it on a GMV comparison. It's an apples to apples comparison rather than a sales number revenue growth comparison, because it doesn't mean anything when the base is different. It's an apples to orange comparison, so it's unfair. So on the second tweet, he says that Alibaba's e-commerce dominance has been threatened by Douyin, which is TikTok. So GMV for Douyin came in at 1.41 trillion, surpassing even JD.com in GMV of 0.9 trillion, making it tough for Alibaba to retain market share. And Alibaba in this case, in 2022, it came in at 8.3 trillion. So I guess it's still around 5 to 6 times bigger than Douyin. But I do acknowledge the fact, I'm not saying that Alibaba's has no competition, Alibaba is still dominant and stuff like that. It's true. I think Alibaba's growth has been largely stagnated. It's really because of this grabbing of market share from both Pinduoduo and also Douyin. So Douyin essentially came out with a new idea or new business model, which is social commerce, and they really largely incorporated the idea of live streaming and basically they're all out trying to grab market share. And even in Singapore's case, I think TikTok has recently come out with crazy level of promotions where I think first time users can buy most of the products that are worth $10, $12, $15 for only $1. So I think I bought a bag and I bought a shirt for $1 because I used my account and I used my dad's account. But you can see that the cost of that particular bag or that particular shirt is definitely more than $1. In terms of the cost of the materials, the merchants need to earn money, the logistics, the delivery and stuff. So TikTok is essentially just incinerating money to grab market share and to basically get you onto their platform. In terms of whether the sustainability of the growth moving forward, is it sustainable? I don't know. Whether their platform will be sticky, I don't know. Of course, I do have my own opinion about it. I don't think so. I don't think it's sustainable, but we'll keep our eyes peeled. So that is one point to take note. Don't conflate the idea of sales revenue and the amount of products and the GMV that they're doing. And I think one point to also take note is, why is Alibaba's revenue going down? In fact, because you are talking about the GMV increasing, right? It's also because of this increased competition. That's why the margins of Alibaba is getting squeezed, because merchants are going over to other platforms to also sell, and they're not tied down by Baba's platform. So in this case, margins are getting squeezed, and that's why their sales revenue is slowing. But doesn't mean that the number of products that are moving is actually slowing. So that's the distinction. Second part. So even in Southeast Asia, C-Limited Shopee is making it really tough for Alibaba's Lazada. So even though Shopee has a bigger base than Lazada, Shopee grew by 32% versus 13% in FY of 2022. 13% I believe it's Lazada's numbers. So Alibaba's local consumer services segment, including Ele.me, also grew by 12%. Meituan, however, actually outperformed with a growth rate of 21%. And even on the logistics front, Alibaba's Cainiao grew by 21%, but JD Logistics grew 31.2%. Likewise, JD Logistics actually also grew faster despite a significantly larger base. So AliCloud, also supposedly its crown jewel, only grew by 3%. In fact, it has actually lost market share. So there's a lot more competition now for Alibaba. It used to be untouchable, but now its dominance is being challenged. So the intensified competition makes it harder for Alibaba to maintain its influence. So I think these numbers are undisputable facts. But that said, I think on a relative basis, Alibaba is still growing. They are still firing on all cylinders. Yes, it's much slower than many of its competitors, but it's still kind of growing into the valuation and growing into many of these TAM, which is the total addressable market. And they're not just sitting there and waiting to be disrupted and just have negative growth year on year on all their business arms. But yes, I do agree. There's a lot of things that the Alibaba's management team has to buck up on. And I think in my next slide, I did review what they're basically doing now. So firstly, I think the entire breakup of Alibaba's business, it actually signals a lot. I think it is a problem, basically like your iceberg. We only see at the top of the iceberg. At the bottom of the iceberg, I believe that many of the executive team and the management team knows that they're basically slower than many of its competition because the company started getting bloated. They're not as nimble, they're not as agile to basically answer to competition. That's why I think from this entire breakup, many investors are actually excited. They're unlocking shareholders' value. We are able to appreciate more capital upside. But that's really not the point. At least from my perspective as a long-term, I would believe that I'm a long-term shareholder. I would like that from this entire breakup alone, you get people individually accountable for the different business segments and let them be a lot more nimble, a lot more agile to competition. And I would hope that at the end of the day, because of this breakup, Alibaba's bottom line and even top line would look a lot better because of that accountability and for the different teams and sub-teams to essentially react to competition. And that's what I hope will come to fruition and not really the unlocking of shareholders' value and stuff like that. Because honestly, I don't care. I don't care whether I get my returns now, I get my returns in 3 years, 5 years. At the end of the day, let's not forget that at least in the market space, at least in the equity space, investors are only concerned about one thing. That one thing is called profits, or whatever you like to call it. Profits, earnings, cash flows, it can come in many different forms. So if the company fundamentally is able to generate X amount of profits and continue growing their profits, it will be reflected in the valuation. Just be patient about it. So what I'm even more worried about is when the company can't sustainably create that level of profits or margins or free cash flow to return to shareholders, then the rest is all just fluff. And if they're unable to deliver their bottom line, then yes, Alibaba is probably a value trap. So I think just to read off a few headlines on what Alibaba is currently targeting towards, Jack Ma essentially just urges their top executive to go back to Taobao to essentially fend off rivals. And they are also essentially overseeing the entire reboot on Alibaba's entire business. And now, even Daniel Zhang, who used to be the CEO, he basically got demoted. He's no longer the CEO of the group, but he went straight into Alibaba Cloud and to focus basically 100% of his time and efforts to revitalize the crown jewel of the business. So this is basically what they've been doing, or what have been transpiring over the last 2 to 3 quarters. And I do look forward to how they are able to turn the ship around. And yes, it's going to be a tough call or tough turn, but I guess they have to do what they have to do. And that's basically what they are currently doing. So now let's go back to the fundamental thesis behind why we even invested in Alibaba. And let's not move the goalposts, because now a lot of people are excited about the shareholder unlocking value. When I invested in the stock in the first place, that was never my consideration. So this should never be the catalyst for my current thesis. So let's go back to the 3 core pillars that I've been echoing for a good 2 years now. Firstly, it's the growth re-acceleration post-COVID and post-crackdown. We all know that back then, I think when I first started a position in 2020 or 2021, we knew that the COVID lockdown was not going to be permanent, or it's not going to be sustainable. The crackdown too. And right now, we are basically just starting out of this re-acceleration in growth because China is opening up. Yes, there are many concerns about how the consumer is not spending enough money, there is no stimulus, the consumers are basically pessimistic about the future, etc., etc. But it doesn't matter. At the end of the day, once the growth re-accelerates, we will see the numbers. There is no running away from it. So I still stand by this idea of re-acceleration in terms of post-COVID and post-crackdown. We have seen the post-COVID, they essentially opened up already. Now the post-crackdown, we are also seeing lesser and lesser news headlines and articles about cracking down on many of these tech companies. In fact, we are seeing from the highest office that many of them are pledging their support for many of these big tech companies to essentially revitalize the economy. So I think this is well underway. And for those of you who have been in the stock for at least a good 1-2 years now, you are basically waiting for this. And then now you're asking me, I'm too tired of this shit, man. I want to go back to the US stocks and all these Chinese companies are basically just trash. Then, I can't stop you from doing what you want to do with your portfolio, but you have already basically went through this entire cycle of China locking down, negative thesis and sentiments, and then we are basically at the start of trying to re-accelerate growth, and then you say you want to call it quits. It's up to you. Secondly, in terms of the execution on e-commerce and cloud, and I do admire the execution track record of the executive team, but it's true that over the last 2 years, they have basically been slacking off. But right now, because of this breaking up and this new allocation of resources and capital, I do hope that they are able to prove themselves again. But I would just like to say that yes, this part of the core thesis haven't been playing out, and they essentially got an F for this on their report card. And the last part about this idea of valuation reversion to the mean. I know that many of these companies out here that I put, they are not close competitors because they all are in their own domain, and every single capital structure of the companies here are vastly different. So Alibaba is very different from Tencent. Tencent is very different from Alphabet. Alphabet is very different from Meta. Of course, you guys can argue that certain aspects of their business are similar, and you might say that, Alibaba is the Amazon of China and stuff like that. But I do fundamentally believe that there is many nuances in the business. So it's very hard to basically just compare ratios across them. But I think I just wanted to drive home the point into where the valuation of Alibaba sits today. So in case you guys don't know, I'm just going to quickly run you through. The first one, price, which is the valuation they're trading at today. Market cap multiplied, which is price multiplied by total outstanding share. Net cash position, short-term plus long-term debt. Enterprise value, basically is just a market cap less cash at debt to basically know the capital structure. And then the FCF TTM is basically free cash flow trailing 12 months. So there are a few ratios that I've used here: EV to free cash flow, enterprise value to free cash flow, price to free cash flow yield, PE, which is price to earning, and forward PE, forward price to earnings. So I think just glance over and just look at it. I do believe that many Amazon investors will say that, you shouldn't look at all these numbers. And just a disclaimer, I'm also an Amazon shareholder. And I do agree that some of these metrics are pretty flawed. In this case, it isn't really a very good representation of Amazon's current business segment and how it's performing as a business. So I think I'm just putting it there just for some sort of reference. And even for Meta and Alphabet, even though many people say that they are very close competitors, so even for Alphabet, they currently have Google Cloud, so it's fairly different from Meta's case, even though their main business is still in the advertising space. But just to give you guys a quick run through, I think Alphabet's case, if you were to compare it comparatively or relatively between Amazon, Alphabet, and Meta, they are basically the cheapest out of the lot. So in terms of their price to free cash flow, it's around 25 times, and their free cash flow yield is around 3.95%. Their PE ratio is now 27, and their forward PE is 22.5. So then, in layman terms, what it really means is price to free cash flow. Theoretically speaking, let's assume that Alphabet gets in X amount of free cash flow, and in this case, it's around $60 billion for the last 12 months. And for the next foreseeable future, they're going to return all the free cash flow to shareholders. Whatever they get in, they're just going to not reinvest in the business, they're just going to return it to shareholders. And it takes around 25 years. Assuming that there's zero growth, to get back the entire market cap of Alphabet today. And that's basically what it means by price to free cash flow, or what's the free cash flow yield. And many people like to compare the free cash flow yield with the current bonds and T-bills and whatever rates they get, because technically or theoretically speaking, you're supposed to get a higher yield for investing in companies. But let's not forget that for bond rates, in this case, you are getting a fixed percentage, while for many of these equities or companies, you're expecting them to grow. So even though you might overpay for some of this free cash flow yield, in the long run, if they're able to continuously grow, then you are probably expected to get a much higher yield. But I think if you to contrast it, let's not talk about Alibaba first. Let's talk about Tencent. So Tencent, which is also another darling of Chinese Wall Street, it's currently trading at around a 16.5 times price to free cash flow, and it's at a 6% yield. So is 6% yield cheap or expensive? I think you need to look at it on a relative terms. When you compare the Chinese counterparts, big tech counterparts with their American ones, evidently it's cheap. I think it's probably close to 2 times cheaper or half the valuation of Alphabet today. If you were to use the free cash flow yield percentage, then you can include in your China discount or whatever nonsense you want to talk about. But that's besides the point. So even Tencent is trading at a PE of 15, forward PE of 20 times. And then when you reflect it to Alibaba is trading at a free cash flow yield of around 11.5% today. Its price to free cash flow is 8.6 times, and the PE and forward PE is around 22 and 8.9 times. So what it means, like I said, assuming that Alibaba's free cash flow doesn't grow from here, it just keeps generating around 25 billion of free cash flow for the next 8 years. And assuming that you return the free cash flow to shareholders, within 8 years, you get back all your money, which also explains why the free cash flow yield is 11.5%. So many people are going to bounce back, oh, it's going to be a value trap. So in order for it to be a value trap, you really have to think of it from a business owner perspective. So let's say I have the ability to own Alibaba, the whole company today. In order for it to be a value trap, meaning the free cash flow that they're going to generate or the earnings they're going to generate is probably going to go negative, meaning it's going to start going downwards and it's going to start tapering off. That's when it becomes a value trap. If not, if Alibaba is going to hold its cash flow there, specifically at 25 billion or 20 to 25 billion, the range, for the foreseeable future, then yes, I'm going to get back the capital within 8 years and the yield is going to be 11%. And think about it, for a big tech company in China, whether you apply the China discount or not, you're getting an 11 to 12% free cash flow yield. And I haven't even add in the net cash position because let's not forget, Alibaba is like a $60 billion cash reserve. And if you take the 60 billion minus the 210 billion, meaning that you should actually use it to have a more accurate picture, you should divide this free cash flow based on the market cap that is less of the cash position. So then you'll say, oh, why don't you compare it with the rest of the other big tech as well? Yes, it's true that other big tech also has huge cash reserve, but I think on a relative basis, if you compare it to their market cap, the impact is not as large. 70 billion on a 1.31 trillion, 111 billion on a 1.5 trillion, and 37 billion on a 721 billion. And Baba in this case, 60 billion on a 210 billion. So you are essentially wiping out around 20% of their market cap. And if you apply the 25 billion free cash flow multiple on that 150 billion market cap, you get an even more ridiculous amount. So I'm just trying to set the context straight for people to understand the free cash flow position and the yield of Alibaba's valuation today. And on the second point, people like to say that, because Alibaba is a dying business, the earnings or the growth rate is not expected to be good. And you look at all the rest like Tencent, Amazon, Alphabet, Meta, they all still have great runways ahead. They are still, even though they are matured, they're not as matured. But if you to really compare the analyst consensus, let's just take Alibaba versus Alphabet because Alphabet is deemed to be the cheapest, right? So Alphabet's year-on-year growth rate for their earnings is expected by analysts, by Wall Street, to be around 15 to 18% or 15 to 20% in that range. While Alibaba in this case, the expectations is around 7 to 11%. So the difference in probably price or the difference in valuation, is it really justified? Just make that comparison. Alphabet is, yes, it's going to grow a lot faster than Baba, even though it's a bigger base. But it's not by a very large extent, meaning Alphabet is not growing at 30% and Baba is growing at 5%. It's not. I mean, the consensus now on the relative valuation basis is 7 to 11% versus 15 to 18%. And this is the difference in terms of the valuation today. So does it really make sense? I don't know. You guys make the decision on your own. I'm betting that it doesn't make sense. And I do believe that there will be some sort of valuation reversion or mean reversion or reversion to the mean for many of these Chinese companies. But yes, if you take into account that, Tencent is also probably, in terms of a free cash flow yield basis, it's twice more expensive than Baba. But I would agree to a large extent that Tencent's business model is a lot more diversified, a lot more resilient, and the business model is probably better than Baba. But is Baba supposed to trade at this valuation? I don't know. So that's just something to think about. And for those of you who are really expecting Baba to, because you claim that Baba is a value trap, you're expecting Baba's earnings, free cash flow to just basically plummet and go down. I don't think so. At least even Wall Street don't even agree with that because they are at least postulating for a 7 to 10% growth in the foreseeable 3 years. So that's just some general discussion points. And I think just a last concluding slide. For those of you who don't know how to read Chinese or can't read Chinese, a good friend of mine sent this into a group, and I think it's a pretty interesting wrap up to this entire discussion. So in Chinese it reads: 每3个香港成年人就有1个买爸爸输到甩裤. If I can translate, it just means that in 3 Hong Kongers or 3 Hong Kong adults, there is one that bought Alibaba and they managed to lose their pants because they've lost too much money. For whoever that held Baba for whatever time period, 1 year, 2 years, you guys are probably still deep in the red, including myself. And this is just a very light-hearted ending. Of course, many of us are still red, and for those of you who are practicing conviction and practicing discipline, I do still see that there is a great opportunity for Baba to revert and for Baba to basically realize their value. But before that, I think it has to come through their earnings and it has to come through in terms of execution of the business first. So hope you guys enjoyed the discussion. And if there's any questions, do feel free to leave in the comment section down below as well. And of course, don't forget to smash that cute little like button. And with that, we'll see you in the next video. But more importantly, I'll finally see you on the moon. Goodbye.